Good afternoon, ladies and gentlemen. I am Carol, the moderator for this conference. Welcome to the first quarter FY24 earnings conference call for Motilal Oswal Financial Services Limited. We have with us today Mr. Ramdev Agarwal, Chairman, Mr. Motilal Oswal, Managing Director, Mr. Naveen Agarwal, Director and CEO AMC, Mr. Ajay Menon, CEO Broking, Mr. Ashish Shankar, CEO Wealth Management, Mr. Shalibhadra Shah, Chief Financial Officer, and Mr. Chetan Parmar, Head Investor Relations. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to invite Mr. Naveen Agarwal to make his opening remarks. Thank you, and over to you, Mr. Agarwal.
Good afternoon, everybody, and welcome to the first quarter FY24 earnings call of Motilal Oswal Financial Services. I'll start by taking you through the highlights of the operation and the financial performance. Our consolidated revenues stood at 12.6 billion during the quarter, up by 32% year-on-year and up by 11% sequential quarter. Our consolidated operating profit after tax during the quarter was at 2.4 billion, up by 28% year-on-year and up by 3% quarter-on-quarter. We reported one of the highest consolidated quarterly PAT at 5.27 billion, which, including the OCI profit, was at 6.72 billion. As we discussed in the past, the large part of the net worth which is allocated to fund-based activities, as per the index, needs to be marked to market on a quarterly basis, and this is usually lumpy and not accruing equally, in each of the quarters. I'll talk a little bit more about this later in the call. Our core businesses were quite robust this quarter. We reported the highest ever capital market business profit of 1.55 billion during the quarter, driven by growth in our retail cash ADTO market share by 46 basis points year-on-year and 110 basis points on a quarter-on-quarter basis to 6.2%. Retail F&O premium market share stood at 7.2%. You may be aware that this disclosure by the exchanges started in the last quarter, and so we now report in our presentation both the premium market share as well as the F&O ADTO market share. So the premium market share stands at 7.2%, and the ADTO F&O market share for retail business stands at 4.3%. This number also, the ADTO market share, is also up by 111 basis points year-on-year and 44 basis points quarter-on-quarter, resulting in an overall average daily turnover increase of 171% year-on-year and a very strong 28% on a quarter-on-quarter basis. NSE active clients for us stood at 761,000 numbers as of June of 23, and our market share has been stable at 2.5%. We acquired an additional 100,000 clients during the first quarter. The distribution AUM within the retail broking and distribution business increased to 223 billion, up by 20% year-on-year, and our incremental distribution net sales were at 3.2 billion rupees during the quarter. Here again, we have made additional disclosures in our presentation. I'll cover that later in the con call. Our currency market share improved meaningfully by over 4% quarter-on-quarter to 22.7%. Our institutional equity business ADTO also grew by 67% year-on-year, 62% quarter-on-quarter, and the investment banking business saw 6 successful completion of transactions aggregating 37 billion rupees, and we continue to have a reasonably strong pipeline of ECM mandates to be executed in the rest of the year. Turning to the asset and wealth businesses, the cumulative profits of the 3 asset and wealth business, public market mutual fund, PMS, AIF, private equity as well as the wealth management business, cumulatively stood at 641 million during the first quarter. The asset management business AUM crossed 500 billion. We closed the quarter at 515 billion across our mutual fund, PMS and AIF assets. This number was up 19% year-on-year, mainly led by the mark-to-market gains, and 13% quarter-on-quarter. Our revenues for the quarter stood at 1.38 billion, which is up by 5% quarter-on-quarter. Mutual fund AUM stood at 335 billion, and we are hopeful of growing this mutual fund AUM, led by strong performances and turnaround in our active mutual fund schemes. This quarter, while our net sales continue to be negative on the back of redemptions, I'm happy to report that our gross sales for active mutual funds were up by 90% year-on-year. This is also reflected in the SIPs. New SIPs during the quarter were 130,000, up by 170% year-on-year and 42% quarter-on-quarter. And we also saw an improvement in our SIP flow market share. Our wealth management business AUM grew very sharply by 90% year-on-year, 28% quarter-on-quarter, 664 billion. This also includes certain DP assets and some lumpy additions is causing this 93% year-on-year growth. Our private equity business fee earning AUM touched nearly 10,000 crores across 3 growth capital funds and 4 real estate funds. In the first quarter, our revenues grew by 22% year-on-year to 388 million. We are happy to announce the launch of our 6th real estate fund during the quarter with a target to raise about 20 billion rupees as compared to the 5th series real estate fund that raised 12 billion rupees. So this is a substantial ramp up and should add to our AUM during the course of the coming quarters. Our fund-based profit, including OCI, stood at 4.3 billion during the first quarter. And as a result of the strong market and the mark-to-market, our consolidated net worth rose to 69.3 billion at the end of the quarter. Our debt equity stood at 1.5 times. In terms of an additional slide that we have added to our presentation this quarter, we reported our net worth since FY15, and the 69.3 billion rupee marks a compounded growth of 23% during this 8-year period, 8-year plus period. After a 28% average dividend payout and after all the buybacks that we've done, on the back of the twin model of strong operating business return on equity, combined with a 17% post-tax ex-IRR on our fund-based investments. Our operating profit after tax contributed to 70% of this net worth augmentation over the last 8 years, and the balance 30% was contributed by our fund-based investments. Turning to a few more insights on our wealth management business. In our private wealth business, we have clearly laid down our strategy to strengthen our relationship manager base in FY21, and we had guided for a 300 member relationship manager base by March 2026. We are tracking well on that plan and have added a net 74 relationship managers over the last couple of years to reach a total RM count of 197, which is up by 60% during this time period by the end of this quarter. Further, we strengthened our regional leadership positions across key geographies in West and South India, and have also onboarded Ultra HNI client vertical head last year. These investments in relationship manager and strengthening the leadership is expected to continue in the coming quarters as well, and will have a short-term impact on our profit margins for the wealth management business. However, we believe once the vintage of RMs improve, the operating margin should move back to the 45 to 50% range. Another disclosure that we made during the current quarter in our investor presentation is a disclosure on revenues and profits from businesses catering to wealth clients. Hitherto, we've been reporting our private wealth business separately. The private wealth entity offers products and services across platforms and asset classes to 5,650 families. There are another 8,000 HNI clients housed in our broking and distribution entity, serviced through a dedicated private client group, which offers not just broking products, but some of the financial products curated by the wealth business, and has a DP balance of 45,000 crore rupees. This group supplements the private wealth business and jointly covers a wide spectrum of clients from mass affluent to HNI to ultra HNI families. Turning to our HFC home finance business, we've strengthened our senior management team through key hiring in leadership positions. Sukesh Bawal has joined as the Chief Executive Officer of the company and brings in 27 years of rich experience in the mortgage industry. In the previous stints, he's been associated with Citibank for over a decade and DCB again for over a decade, where he headed the mortgages, micro mortgages, construction finance, and gold loan segments. Shobit Guru has been appointed as the Chief Operating Officer. Shobit has 25 years of experience across product, strategy, and analytics in mortgage, LAP, and SME businesses, and most recently served for over a decade at Bajaj Finance. Rajesh Maya has come in as the Chief Business Officer. Rajesh brings over 25 years of experience in sales and distribution, channel management, and customer service. He served in organizations like Nestle and ICICI Bank for a large part of his career and spent the most recent years as the National Sales Manager at Aavas Finance. With senior management team onboarded, our next priority is to strengthen our sales force in the next 6 to 9 months, and all of this should help us drive growth in the AUM from the next financial year. To sum up, we have delivered strong performance in the first quarter. Our capital market business has demonstrated remarkable performance, reporting all-time high profits and strengthening our retail market position in cash as well as F&O segment. It shares of 6.2 and 7.2%. Asset and wealth business AUM has crossed 1.25 lakh crores. Asset management business has seen improvement in performances across multiple products and is seeing traction in gross sales. Wealth management business continues to strongly march towards the 300 RM base besides strengthening leadership. Recent appointments in the home finance business should drive the second phase of AUM growth for the home finance business. With the strengthening of each of our businesses and the tailwind provided by rising savings and financialization of those savings, we hope to continue compounding our net worth on a bigger scale at similar rates as we have reported in the past. Thank you, and we're open to Q&A now.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session.
Sorry, I'll just add one more point this missed my attention. So basically, we've also filed with the exchanges an expression of interest from our two co-founders, Mr. Motilal Oswal and Mr. Ramdev Agarwal, both promoters of the company, co-founders of the group, along with their family members. Each of them will be donating 5% of the equity shares of the company, aggregating to 10% of the outstanding shares of the company towards charitable purposes, either in a single contribution or through a staggered approach within a period of 10 years. Mr. Agarwal can elaborate on this during the course of the Q&A. Over to you, operator, for the Q&A.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star then one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vinod Chandra Agarwal, an individual investor. Please go ahead.
Hi. Are you able to hear me?
Yes.
Yeah. Hi. First of all, congratulations for a good and very good set of numbers. And second, thank you for giving me the opportunity. And by listening this, that the promoters are giving 10% to the charity cause, that's really a great noble cause. For that also, I would like to say thank you. I don't know what matter, but the cause is good. So that really makes believe that the promoters' honesty and responsibility towards the society. So again, thank you for taking that decision and going towards that. Okay. And one request I would like to make, which in our annual general meeting, I did send an email to represent myself as a speaker well before on the time, but I didn't get a response and I couldn't be a speaker. So if you can just make our investor relationship officers little bit more, I would say, responsive, that will be good. It's not a complaint, but just a request.
Yeah. So we have actually given opportunity to all the investors who had come in the queue. However, in case if unfortunately we would have missed, then we will certainly take care of that.
Yeah. Thank you, sir. And now I will start with my some understanding in the home finance business. And I'm an individual investor, so my questions would not be related to the analysis, but kind of understanding of the business. Okay. And the main concern is our return on equity on our home finance business. If you look at that, even though like 5-7 years has went, our return on equity of home finance business is the lowest amongst the all other business. All other business are doing well, even if our fund-based investment is also doing a 17% ROE. But home finance business is just last year has done with only 13%. That too taking a 2.3x leverage. Right, so that is something a concern. That why it's something like that we are doing this business. Do we not have any other opportunity where we can put this money into other business? If you can elaborate. Another thought is that why we are not going with some higher leverage if we want to increase our ROE. Another option I thinking in myself is that even though our real estate fund who is giving a 20% IRR and our home finance business is giving just a 13% ROE. So just a thought if something we can do there. If you can just explain, that's like what is our target to reach this ROE in the home finance business and why we are investing in the home finance business even though we have some other avenues where the return on equity is high. Thank you.
Yeah. So with respect to home finance business, so we are into actually lending into affordable home segment, and this business certainly we have been building brick by brick. If you actually look at our total loan book, then we are at 3,750 crores of book, and actually last financial year we have been adding a lot of talent in this business over last few years. And the idea is that we would be improving more talent on the sales side to actually improve the throughput of the disbursements of this business. So last financial year we did 1,000 crores of disbursements. The idea is to grow the book, and as our book growth improves in this business, the overall leverage would improve and would translate into a better return on equity to the shareholders. Currently, our return on assets stands at 3%. The idea is to improve the overall ROA to 3.5%, and also at the same time have a strong asset quality of the business, which will help us to improve the overall ROA and ROE in the business.
Thank you. Before we take the next question, I'd like to remind participants to ask a question. Please press star then 1. The next question is from the line of Anshuman Deb from ICICI Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is on the capital market segment. Obviously, we have done good, but what I wanted to understand was that is it as an X of investment banking, the core retail business, how is profitability shaping up in terms of the business, in terms of whether we are kind of decreasing the yields for the market share, because we have done very good in the market share gain perspective. So that's question number 1. The second question pertains to the asset management business. You said that the net flows remain negative, but we have shown very good growth on the gross side. So any initial trends on the distribution side in terms of the flow share over there, our discussions with the distributors and the reflection of improving fund performance, if you can give some color on that.
Yeah, that's Ajay's responding. One. So, overall on the capital market side of the business, so actually, as far as our retail broking business is concerned, that has grown in terms of profitability by 19% on a YOY basis. And even on a quarter-on-quarter basis, actually, if you look at our retail broking business, while it is looking flattish, but overall it includes quarter four includes also the impact of the insurance revenue. So in that, if you actually look at it sequentially, even the retail broking part is up at 20%. In terms of the yield, actually, cash yields have been actually stable and in fact improved in quarter one of this year. So apart from volume growth in the market, our market share has improved as well as the yields have also marginally improved. As far as the F&O yields are concerned, certainly the yields are marginally down. So year on year the yield has been coming down, but volume has been more than compensating for the yield loss. And again, in this quarter, the mix of the brokerage towards cash has improved. So that overall mix of our yields is also better QOQ and YOY as well.
Turning to your second question on the traction with distribution on the back of the turnaround in the asset management business performance, I'm happy to share that across 6 channels that we track, the banks, we've seen onboarding of some of our performing products by the largest of the banks in India. The same has been the case with the wealth platforms in terms of our new founders, AIF, PMS. In fact, in our presentation, we've highlighted that very early into the launch of this product in the first quarter itself, we crossed 500 crores of AUM for that product. So we're seeing traction on both the alternate side as well as the mutual fund side. During the quarter, we also launched an NFO of the micro cap fund, which raised over 100 crores. This is an innovative, first of its kind passive product that we see headroom to grow. Turning to the retail channels, we've also seen onboarding by some of the large national distributors of our performing products. IFAs, we've seen a very strong uptick as well. The digital channels, again, we've seen very strong traction in the last quarter. And lastly, in terms of the direct flows, also we've seen a uptick. So I've also shared the SIP numbers, which are up almost 2.7x on a year-on-year basis. So at least the gross flow traction is strong. We are hoping to convert this into stronger net flow traction also. This quarter, I must highlight that on the back of the turnaround in the performances, we saw some of the long-standing institutional investors in the mutual fund see some part redemption to take some profits, partly also because of the market scaling to a new high, and that is what is muting the AUM growth. That is now stopped, and we are hoping that the second quarter should see stronger traction as far as the net flows are also concerned, while you will continue to see uptick in the gross flows for the asset management company.
Great. Yeah. Thanks a lot. And one last question is on the housing finance side. So, we have a new team over there, and as you said, we want to kind of capitalize on that going ahead. So, any kind of target in terms of AUM growth or the ROA trajectory for the next 2 years would be helpful, considering that in this quarter we have not seen a meaningful growth, but an increase in provisioning. So, any color on that, James? Thank you.
So, as I covered in my opening remarks, the purpose of hiring veterans with over 2 decades of experience in prestigious organizations like Citibank, Bajaj Finance, our PCB, is to ramp this AUM up to the second phase of growth. We are hoping to double the size of the sales team from a tad under 500 to nearly 1,000, over the next 2 to 3 quarters, while keeping the branch network the same. So you will see some, benefit of, cost income as the control functions across collections, operations, credit may not need, a proportionate enhancement. So, increasing the, sales team with the same branch network and the same control functions, we are hoping that in the coming quarters, you should see, meaningful quarter-on-quarter disbursement traction. Let's say definitely the fourth quarter, exiting quarter of this year should see, pretty good numbers according to us. But we are not giving any guidance, hoping that, when we report the full year numbers, we'll most likely present to you a, 3 to 5 year plan for this business as well, in terms of AUM, ROA, ROE targets.
Great. Wish you all the best and thank you.
Thank you.
Thank you.
Thank you. The next question is from the line of Bhuvnesh Kar from Investec Capital. Please go ahead.
Hi. Thank you for the opportunity, sir. So just wanted some color on our wealth business and our HNI business. So if you can just explain that between our wealth management and broking and distribution. So how is our customer division? So on what profile of customer is considered under wealth management and what profile of customer comes under broking? And how are the products offered different between two divisions? And why this, we have separate divisions? Why not one combined division for it? Yeah.
I think the point of acquisition of the customer is really different. The broking and distribution customers may have predominantly been a broking first customer, and over a period of time have seen cross sales of mutual funds, AIF, PMS, real estate funds, debt products, etc., etc. In the case of the wealth management business, necessarily the first point of contact may not be the broking business in all likelihood. It may be a financial product. Also the cutoff, so you may see a much smaller starting cutoff of AUM as far as the broking business is concerned, or it may even be zero. You may just start with broking and bring your DP balances to the firm. On the other hand, there will be a cutoff as far as the wealth management business of a minimum of 2.5 crores.
Got it. And sir, any difference in products offered between wealth management and broking?
The wealth management team is obviously more sophisticated to be able to, handle financial planning, estate planning, many other, services. Some of them may not be offered. A subset of those services may be offered by the private client group within the retail broking and distribution business. However, our endeavor is, like we're growing the relationship manager base in the private wealth management business. We spoke about trebling that by March 26. We're looking at an equally strong increase in the relationship manager base of the distribution business, and also to increase the coverage of products that the private client group offers based on the curation by the private wealth business.
Okay, sure. And sir, what's the definition of our HNI clients? In terms of individual, surplus, or network?
As I said, the onboarding has to be a minimum of 2.5 crores of AUM for the private wealth business. We don't have any such definition I mentioned to you earlier for the private client group, because they could be a broking first customer.
Fine. And sir, just in terms of our financials, so we are now on trail model on most of the products. So in that scenario, have we adjusted the compensation for RMs accordingly, or RMs are still, their compensation is still what it used to be? Compensation.
So you're right that most of the products now are on a trail basis, but we consider the broking revenues accruing from private wealth customers under transactional revenues. And there are certain other products like bonds, etc., which also help us accrue transaction revenues. What's the second question?
Has the question been answered? RM, yeah. Second question was on the RM compensation. The RM compensation continues to remain same.
Okay. So in that case, so do we expect that higher cost to income since our now revenue would accrue later on, but our compensation, RM compensation would all be upfront? So in that case, how do you see our cost ratios moving?
So I think whatever we've seen, over the last couple of months, the productivity numbers are moving as per earlier numbers itself. Because there is still broking, which is part of transactional revenues, and there are other revenues like bonds, etc., which kind of compensate.
Got it. And sir, if you can share some data on AUM client attrition and employee attrition in our wealth business, how it has been for last couple of years, kind of it.
Yes, sir.
Yeah, we can share that separately with you.
Sure. Fine. That is from my side. Thank you for your answers. Have a good day. Thank you.
Thank you. Thank you. The next question is from the line of Supratim Datta from Ambit Capital. Please go ahead.
Thanks for the opportunity. So I follow on from the previous question. So on the wealth side, you have grown by around 35%. Just wanted to understand that, what would be your customer mix here? And, when I'm saying customer mix, I wanted to understand, what would be the high net worth customer proportion versus the high net worth customer proportion? And how are you planning to, grow beyond the tier 2, tier 3 on this, the wealth side? If you could give some color on that, that would be very helpful. And the second question was, on the investment front in this wealth business, so you have indicated that you have onboarded about 54 wealth RMs. How are you planning to continue this investment going forward? So, how much more investment needs to get into this business to get to a stable base? If you could give some color on that would be also very helpful. Thank you.
Yeah, so on your first question, in terms of mix of clients, currently about 10% of our clients would be ultra high net worth family office type of clients, and otherwise bulk of our clients would fall in the HNI category. I'm defining the ultra high net worth family office clients as 100 crore plus AUM with us. But in terms of assets under management, the ultra HNI segment will comprise about 37% of our assets currently. Your question on RM addition, I think we had mentioned earlier that we are committed to ensuring that we reach the number of 300. I think we had mentioned this number that we'll reach by 2026, but at the current pace of growth, my sense is that we will reach it much earlier.
And thank you. And if I could just add one follow-up question to that. So typically, how long does an RM take to hit full maturity?
Is your question on
RM break even and then productivity?
Yeah, typically our RMs break even between the second and the third year. The way it works is that first year the RM productivity is normally 1 to 1.5x of their cost. Second year it moves to 2.5x, and by the third, fourth year it moves to greater than 3 times, and that's when the RM breaks even and becomes profitable for the firm.
Got it. Thank you.
Thank you. The next question is from the line of Pujan Shah from Congruence Advisors. Please go ahead.
So hi sir, first question from my side would be, if you look at the home finance side, and on the NP and GNP have also been rising from FY20 to FY23 basis. If we look at the specific target, we have been focusing AUM ticket size has been specifically for 5 lakh to 15 lakh the ticket size. Now in that segment, I don't able to understand what I've been able to, why the spread, the NIM, the cost to income has been increasing, even in this specifically the banking cycle. And my second question would be on the diversified liability mix. If you look at the FY20 mix, it would be more of the NCDs, and then we have started to mainly focus on term specific. So NCDs has been reduced from that part. So can you just explain for that specific?
Yeah.
So answering your second question first, actually on the overall liability mix, we have now NHB refinance, which is coming, which is almost 21% of our liability mix, which is a low cost finance. And that is one of the reasons where that is taken the seat of NCD. So NCDs are generally 3-year tenure, and NHB refinance comes with 8 years to 10 years tenure. So we have actually replaced the longer tenure liability mix with a lower cost, and that is the reason for reduction in the NCDs. In terms of the overall spreads, so spreads have been healthy for us. We have actually the total spread of Q1 stands at 6.1% and is marginally up YOY. In terms of the cost to income, as highlighted earlier in the call, actually we have been adding a lot of senior talent for our next phase of growth, and also so we are investing in the manpower. And especially also on the additions on the sales side of the team. So that is one of the reasons where cost to income would marginally go up in the current financial year and in the next financial year. But you would also see the throughput of the run rate of the disbursements improving, which would then bring down the overall OPEX to AUM. And we expect to maintain ROA. Our current ROA is at 3%, which we expect to maintain above that.
Okay, sir. I just wanted to add a question on specific as we are hiring to senior guys out there in home finance. So what was the lag we found that this would be the lag in our core business, and these are the persons who can add on to this value and can change the trajectory of this business. So what are the lags we have found out in the initial phase, and then how we are visioning to change all this? What is the first focus for this specific thing?
Yeah. So as you know that this business was being driven by Mr. Oswal as a interim arrangement till we strengthened our digital platform, our underwriting processes, put the collection in order. I think all of that is behind, and I think from setting the house in order, getting the credit rating upgrade, bringing down the cost of funds, improving the efficiency. I think all that is done. I think in the next phase of growth, we are looking at, as I mentioned earlier, growing this AUM meaningfully with the kind of distribution, state presence that we have. I think we are embarking on that journey, and as you may be aware, as co-founders, we have professional CEOs and management teams for all the 7 businesses that we are in, and the co-founders do not directly run any of these 7 businesses. So those are the few thoughts. There's a lot more bandwidth that is required for the capital allocation strategy, business reviews of the firm across these businesses, and so Mr. Oswal then goes back to his original role.
Okay, got it. Thank you so much, sir, for this detailed answer.
Thank you.
Thank you. Before we take the next question, a reminder to all the participants, if you have a question, please press star, then 1 on your touchtone telephone. The next question is from the line of Devesh Mehta from Dinero Capture. Please go ahead.
Yeah, I had one question, a simple question. So I was very excited to understand the scheme which was launched recently by Motilal Oswal, the microcap 250 index fund, sir. So it's a kind of a unique fund which is not there in the industry right now. And what I want to understand is what was the thought process in launching such kind of scheme, and is there any pipeline of such kind of schemes going forward in future where we think that we can improve our AUM and we can improve our SIP flows also through this?
Yeah. So as you know, we started our journey in passive with international products. We were the first licensee of NASDAQ well over a decade back. We were also the first licensee of S&P 500, and we followed that up with our emerging markets, FIFA, and other interesting fund launches. After the RBI embargo on further investments overseas, and we had maxed out our limit.
Yeah.
Our next focus was to build an equally strong domestic franchise, and I'm happy to tell you that for a lot of our products, we've been the first to launch those products in the industry, and we are the leaders. Aside of the mega products like the Nifty 50, where we don't have a standing, I think through innovation, through being first to market, through filling the product gaps, our idea is to keep launching more products, offer best-in-class tracking errors, and basically provide more financial solutions to the retail investor base. I think microcap is one more such initiative. We also have the largest mid-cap fund, and the small-cap fund is already in place. So if you see announced, and also our focus is the NSE 500 fund also. So I mean, we are straddling the entire spectrum, and we have a pipeline of funds that we filed with the regulator, SEBI, and hoping to get approvals. As and when we get those approvals, we will see us launching more and more of these products in the coming years, as we believe that the runway for passive asset management is also extremely exciting.
Okay. Thank you, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Kartikeya Mohta from B&K Securities. Please go ahead.
Yeah, hi. This is Swarnab. So I had 2-3 questions. First of all, thank you for the opportunity to ask the questions. I just wanted to understand, first of all, on the wealth management business, the disclosures that you have made. Hello. Am I audible?
Your voice is not clear. Can you be more loud?
Yeah, just give me a moment, please. Yeah, is this better? Yeah. So on the wealth management side of the business, I was looking at the mix of transactional and recurring revenue, and what I see is that the share of recurring revenue has come down in the mix. So is this a function of just that, given how the market activity level has increased, and hence you are seeing more, more transactional revenue flowing through that, or is there anything else to read into that? That would be the first question. Secondly, in terms of the disclosure on AUM per family and revenue per family, what I see is that the jump in the AUM per family has been much more pronounced than the revenue per family. So is that the new customers are coming in at a lower yield, or how? If you could explain that. So that's the question on the wealth side. I have a couple of other questions, but I'll ask them after your response.
Yeah. So on the first question, actually the transaction revenue going up is not a function of the recurring revenue going down, whereas we've had broking revenues move up sharply in the wealth management business, which is counted under the transaction revenue head. Secondly, till April 30th, upfront revenues were still there on many products. It is from May 1st that the upfront revenues have gone away. So you'll see that smoothening probably from the next quarter between transaction revenues as well as recurring revenues. On the second question, on the AUM front, as explained earlier, there was a sharp addition in terms of AUM, and a large part of it also came through DP assets, which we have classified. If you look at the presentation, we've classified our AUM between custody assets and revenue earning assets. So if you look at just the revenue earning assets, our yields are more or less constant.
Okay, got it. In terms of the number of live SIPs that you have mentioned, that number seems to be fairly steady, say between FY22-23 and also in the current quarter. So how should we look at it? Is this a function of us not really going aggressive on this? Because we see other players, maybe not in your direct customer segment, but maybe on a slightly lower scale, they are seeing very strong growth. So just wanted to understand how to read this.
Right. So if you look at the SIP flows, we were at 339 crores for the first quarter of last year, right? And this quarter, this number is 532 crores. Now, a lot of the increase is because of some headroom that has opened up in the passive business, right? So the passive business SIPs have grown even faster. However, even the active side SIPs, in terms of the quarterly flows, have gone up from about 280 crores to over 330 crores. So that's a growth of nearly 20% on a year-on-year basis.
Okay, understood. Lastly, on the broking piece, I just wanted to understand how you were seeing the dynamics playing out on the retail broking part. So, discount brokers vis-a-vis, say, ad valorem players. How is the market share moving? What are you, what are the kind of levers that you are planning to press? I guess, I mean, from your presentation, one thing that you have highlighted, I think, the sizable share of HNI clients in your broking and distribution PBT. So, I just wanted to understand how is our focus on the, much more granular side of the business, and whether we are actually, trying to focus more on the HNI bit and defocusing from the more, the more retail side of the business.
Yeah, so we have been looking at the overall broking business always from a quality perspective, and our acquisitions are also based on getting more quality clients on an overall basis. So if you look at the number of clients, comparatively will be lower, but we look at margin clients and where we are able to get the ARPU in our favor. Along with that, the focus has been very clearly on getting the mix of broking and distribution together. So the distribution AUM is also growing at the same time to build on the overall broking business. So our focus has always been in building the channels based on quality, where we have a good franchisee network who's getting us quality clients. Then our PCB channel, which is doing very well with HNI kind of clients coming in, along with the distribution base. And finally, on the technology-driven digital clients also, we try to see how we can get the quality of the clients up, and we get more and more margin clients who can do much better business on the overall scale.
Okay, got it, understood. Yeah, thank you so much, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Abhijit from Kotak Securities. Please go ahead.
Hi, good morning. The first one is just a clarification in terms of, like, we have some broking activity that happens on the wealth side of the business, and then there is the broking activity, which is the other vertical. So I was just wondering if, I mean, both of the broking activities happen through the same legal entity, or, I mean, how does the regulations, what are the regulations behind it in terms of, having broking between wealth and the usual broking business, whether it's under the same vertical at the back end, and from a reporting point of view, it's reported differently in the presentation?
Yeah, so the broking business happens in a single entity, which is the broking entity, even for the wealth clients. And there is an element of distribution of income between the wealth and the broking for the business and the reporting purpose.
Okay. So the in terms of reporting, the way you categorize is basically depending on how the client is acquired and the nature of the client. Is that understanding right?
Yeah, that's right.
Okay, thanks. So second one, just another clarification on the wealth business. In terms of AUM mix, there is the others, which is what I wanted to understand. If you could just elaborate what are the products there?
Yeah, that others actually comprise of fixed income and structured products as a part of the overall mix.
Okay, all right. And the overall recurring, the yields on the recurring business would be around 75-80 basis points, right, roughly?
It will be about 30 basis points.
On the recurring business?
Yes.
Okay. That seems to be on the lower end in terms of, the usual distribution commissions on the alternates or even on the mutual fund side.
Yeah, See, that's a mix of debt as well as equity, and then we also have assets in bonds, etc. So the blended yield comes to about 30 basis points.
Okay, got it. Thanks a lot.
Thank you. The next question is from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Yeah, thank you for the opportunity. Could you please comment on the demerger of the business? What is the process?
Mr. Oza, I'm so sorry to interrupt, but your audio is breaking up. May I please request you to use the handset mode while speaking?
Okay, now.
So you may please proceed.
Yeah, so could you please also comment on the demerger of our wealth business? What exactly is the thought process there? Why are we demerging that business?
Yeah, so actually this whole internal restructuring is across two businesses, which is broking and distribution and wealth business. So currently broking and distribution is in the parent entity, and by virtue of the regulatory framework, below broking business, we cannot have actually our housing finance and NBFC businesses. So that is the reason where actually we are bringing down the broking business from the parent to subsidiary company. So broking will continue as a subsidiary of the listed parent company. And at the same time, we have wealth management business, which is actually moving up from the subsidiary to the parent company. Because at the parent company level, we will continue to have a operating business in the form of wealth management business, which is done today in a separate subsidiary. So the swap of business required pursuant to the regulatory framework of SEBI.
Okay, so Andreas, this is more of big framework.
Yeah.
Okay.
Okay. Thank you.
Thank you. The next question is from the line of Bhuvanesh Kar from Investec Capital. Please go ahead.
Sure. Thank you for the follow-up, sir. So just have a question on RM productivity. You mentioned that an RM takes 2 to 3 years to break even. And I'm looking at our presentation, so our nearly 35% of RM are more than 3 years to intake. So in that case, how do you see your profitability moving? And what are the hooks we have to retain RM on our platform?
Yeah, so typically what happens is that as the RM vintage grows, profitability in the business grows. So as long as we continue to invest, the margins will be on the lower side. But the moment the vintage of the RMs in the business become much bigger, the 3-year plus profitability increases, and like we had indicated earlier, the margin should revert back to close to 40%.
Okay, and what are the steps we are taking to increase the vintage of RM? So if we look, even if I look at historically, say in FY20 we had around 130 RM. Now in FY23 we have around 190 RM. So we haven't added that many RM, but our A plus RM share is around 1/3. We just want to understand that. So what is the steps we are taking?
Total RM count as of quarter end is 197. So effectively, in the last 18 months or so, we've added gross close to 100 RM.
Okay, fine. Yeah. And any steps we are taking to increase RM retention? Any particular strategy we have in mind?
Yeah, so it's a mix of things that we do on the training front, and as RM vintage increases, what happens is the proportion of recurring in revenues also increase for the RM. That itself becomes a moat, or rather an exit barrier for the RM. And in fact, we've had very, very negligible attrition in the 3 plus year bucket.
Got it. That is so much. Thank you.
Thank you.
Thank you. The next question is from the line of Sanjay Lodha from Bastion Research. Please go ahead.
Hi, sir. Good morning. Thank you for the opportunity. So, sir, I have a couple of questions. First one is, so we have seen increase in market share in cash and F&O business, while on the NSE active client share, we have seen maintained market share on the degrowth of on NSE active client, right? So how should you look at the client addition from both in terms of industry and our company, and also going forward, how should we look at cash and F&O market share improving from here on? What will be our strategy to improve our growth and market share on that front?
As you've seen that the market share on the overall turnover has improved, whereas on the client side it is flat. As we discussed earlier also, we are very clearly focusing on the more margin clients who are more quality giving us business, rather than number of clients where you see the transactions very less. Our focus is on more high-yielding HNI clients and quality of clients who can give us business on a sustained basis, and where we can upsell and cross-sell more products. At the end of the day, the market share and the higher ARPU is what we are very closely tracking. And to that extent, we have made our entry barriers much more based on the quality parameters of margin and ARPU. To that extent, we may not be very much growing on the total number of client base based on the market share there, but surely on the if you see the cash market share and the market share, we have been consistently growing, and in the last quarter the cash market share has grown much more, looking at the market scenarios where the rally has happened on the mid cap and the small caps. To that extent, we are very clearly aligned towards the growth.
Sure, sir. Thank you. So another question would be, as we are focusing more on affordable housing business, how is the competition intensity we are seeing, both in terms of other players and banks, as you know, how you see the housing finance business going forward? As we have seen, the gold finance company is affected a lot due to the competition from banks. So going forward over a 3 to 5 year time horizon, how is this industry shape on, and how is the competition you guys are seeing on that side?
Yeah, so actually, affordable housing is still a very under-penetrated market, and with actually a ticket size between 10 to 50 lakh, and this business is carried out largely through Tier 2, Tier 3 cities and even below, basically, and underwriting happens largely on an income assets basis. So overall, we see a lot of potential for this business to grow. In terms of the competition, a lot of players are regional players, and however, the size of the market is really large. So we believe it is not that intense, and gives us a sizable opportunity given our brand and our ability to raise resources and the ability to grow the business. And again, this is into self-employed segment where banks are shying away from this segment, and where we are not seeing competition. So that gives us an opportunity to grow this business.
Thank you. We take the next question from the line of Vivek from DSP Mutual Fund. Please go ahead.
Good afternoon. First, to start with, let us also share our appreciation for the promoters' gestures towards charity. So the questions I have are on the NPA increase in the home finance business, which increased from 1.9 to 1.9% from 1.1%. Is it because of restructured book coming online or higher interest rates? You've also mentioned that construction finance, which is now 15% of the book, you're going to strengthen further. So wanted to know what is the cap that you'll have on construction finance. And the last question that I have is on the non-HSC book, which is the retail LAS and so on book, that seems to have increased. And I did a calculation and the number seems to be close to 5,700 crores. Wanted to know whether it's right and where you'd cap this number. Thank you.
So coming to the first question on the gross NPA slippage during this quarter. So actually, the slippages are in our restructured book predominantly, and in quarter one there is a slowdown in collections as compared to quarter 4 of last year, and typically in this segment the clients have their expenses in quarter 1, so that is why you see marginal fall in the collection efficiency and resultant increase in the headline numbers. However, the overall restructured book is now quite seasoned, we believe, and even the stage 2 on the book now is close to just 1%. So we believe that in the coming period, the overall efficiency will improve and bring down the headline numbers. Coming to the question on the LAS side of the business, so the number is right, that is at 5,700 crores. And overall, this is basically in line with our growth in our overall volumes and the number of clients that we have funded. So we have almost around 9,800 customers who have availed for this LAS funding. If you look at the overall leverage from the balance sheet, the lever stands at 1.5 times, and the intent here is that for X housing finance, this lever would be within 2X number. So to that extent, we will be capping the overall LAS funding business in this. And I think you asked one more question. Could you repeat your second question?
Mr. Vivek, you may please go ahead with your next question.
Hi, can you hear me?
Yeah, we can hear you.
Yeah, okay. So it was on construction finance. You said you're going to cap it at 15. I mean, it's currently 15%, and in the presentation you mentioned you're going to strengthen that part of the book. So are you going to increase it to beyond 15%?
No. So actually, construction finance, we have capped the maximum limit of 20% on the book, and currently we are at 15%. So, and we would be largely trying to maintain it within this range of 15 to 20% sort of a number, and not take it beyond that. However, again, it's a very synergistic opportunity that we have, because we have a very strong performance done by our real estate fund management team, and this book is also underwritten by with the experience of that team. So that gives us that opportunity to build a very good quality book on our balance sheet, which we will be keeping in the limits which I specified.
Thank you very much. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Shalibhadra Shah for closing comments. Over to you.
On behalf of Motilal Oswal Financial Services, I would like to thank every participant for attending the Q1FY24 con call. In case of any further queries, please do get in touch with us and our investor relations desk. Thank you and have a great day.
Thank you. On behalf of Motilal Oswal Financial Services, we conclude today's conference. Thank you all for joining. You may now disconnect your lines.